Tail risk associated with pandemic fallout has become a lot less worrisome to financial markets, with things calming down and economic data rebounding as a consequence. This leaves investors feeling spectacular into June with a fresh barrage of stimulus and reinforced assurances from central banks and governments that any signs of renewed stress will just be met with more stimulus. And so, not much of a surprise to see U.S. equities recovering all the way back into and towards record highs. Believe it or not, the Nasdaq has already printing fresh record highs, while the S&P 500 has recovered well over 80% of the setbacks from the record high to the March low move. And after the Fed committed to unlimited QE the other month, the ECB has now followed through with its own reassurances, upping its pandemic emergency purchase program by 600 billion euro. All of this has sent a wonderful message to the currency market that it needn't be scared into holding on to US dollars for fear of the apocalypse. Currencies have impressively extended their recoveries, and this is pretty much across the board against the buck, with only the yen standing out as an understandable exception. Domestic risk hasn't been much of a bother either, with ongoing worry about Brexit negotiations doing nothing to prevent the pound from racing back to the top side. And so long as the market continues to buy into the strategy that supports this unprecedented money printing exercise, it seems like there just isn't any downside risk that will be able to shake things up for more than a moment. After all, 2020 has been a year fraught with turmoil, and here we are with financial markets in a state of euphoria. Obviously a disconnect, but again, a disconnect easily reconciled by central bank and government incentives to disregard the downside and invest recklessly in risk assets. At this stage, if we're to consider any potential catalyst that could rock the boat, we would suggest the possibility that the global economic data starts to level out after showing recovery from the worst case forecast, and all of a sudden begins to normalize at levels far from the normal we had seen pre-pandemic. This could be something to watch out for. Of course, there are other risks, including those around escalating global trade tension, a possible second wave of coronavirus, or that next future negative shock to the global economy that tests the resolve of central banks and governments forced to back up those reassurances with even more money printing. We think all of this continues to point to a compelling case for gold, with any setbacks in the yellow metal looking attractive as opportunities to diversify into the limited supply store of value hard asset. The case for Bitcoin is there on these merits as well, though with Bitcoin we can see that it isn't there just yet and still could be exposed to periods of risk off in the shorter term. That's all for now.